And good afternoon, everyone. Welcome to our webinar, Generating Income Using Options with OptionsPlay. My name is Scott Green, Marketing Director with Regal Securities. This is the third webinar in our OptionsPlay series, and we've gotten a lot of excitement and great attendance and enthusiasm over these webinars, so we're glad to do another one. We'll be joined by Tony Zhang today of OptionsPlay, and today he'll be going over what is a covered call, why you should trade covered calls, how you can gain consistency, covered call yields, and more. And for those that are new to OptionsPlay or these webinars, OptionsPlay is a tool on your live trading platform. It's going to be on the live trading platform, not paper trading, to help you with analysis, strategy, and research for trading options. And it is, we've actually relaunched it recently in a more very much highly integrated tool that's within your platform. And I'll point out where you can access it here very soon. And I'll also be introducing Tony of OptionsPlay here, and he'll be the speaker to show us about generating income using options with the tool. And then at the end, the last 15 minutes or so, we'll have time for Q&A. And yeah, and so we'll begin. But first, we just need to share this disclaimer that the types of securities, forms, and research tools used in this webinar are for demonstration purposes only and should not be considered a recommendation by Regal Securities or a solicitation or an offer to buy or sell any options. This webinar will be recorded, which we will end up sharing, and is not intended to be used for individual tax, legal, or investment planning advice. And so with that said, I want to introduce our speaker, the OptionsPlay expert, Tony Zhang, the Chief Strategist at OptionsPlay, the company. Tony has 12 years experience in financial services, and there he oversees the developers, and the team there has led the development of some of the most innovative tools in options trading and analysis. This tool is currently embedded with several major brokerage firms and as well as direct-to-consumer platforms. And Tony has helped take OptionsPlay from the ground up, building both the product line as well as bringing it to market. And so Tony will begin in just a minute here, but I just wanted to point out where you can find OptionsPlay on your trading platform. Again, it's for live trading platforms only. And if you go across the top, you should see an OptionsPlay tab there. And there, click on it, and you should see a screen like this. If you cannot find it or you're having trouble, we encourage you to call your brokerage customer support team and see if you can be able to locate it and find that. So with that being said, I'll let Tony take it away.
Thank you, Scott. Thank you, everyone, for joining us this afternoon. Welcome back for those of you that have seen our previous webinars. Today, we're going to be talking about how to generate income using options, weekly options. So let's start off by sharing my screen here. Okay. If you guys can all see my screen and you can see where it says generating inconsistent income using weekly options. If you see that, please just type yes into the chat window. Great. Okay. Okay, so today we're going to be talking about how to generate consistent income in your portfolio using weekly options. And the reason we're doing this is because this is number one, the single most popular option strategy across the board for all options traders, whether you're individual investors or even professionals. Cover calls to generate income for your portfolio is by far the most popular strategy because it's a strategy that you can use in pretty much all market conditions. You can use it for any stock stock that you currently own in your portfolio. So especially for those of you, maybe you're starting out with options and you're not sure what option strategies to trade, this is a strategy that allows you to generate income in your portfolio without adding additional risk. And you can do it if you're bullish on the stock, you could do it if you're bearish on the stock, you could do it in high volatility environments or low volatility environments. Pretty much across the board, you can do this strategy all the time and generate consistent income in your portfolio. So today we're going to talk about the mechanics of this strategy and how to go about doing so that you can achieve consistent results using this type of strategy. Now, I'm going to focus the conversation around covered calls because it's the most popular strategy. But for those of you that are trading short puts, you can use the same everything that we're teaching you today to use for short puts, and we'll show you how to utilize our platform OptionsPlay to scan for both covered calls and short puts. So if you own the stock, you would typically want to sell a covered call. For those of you that don't own the stock but may want to own the stock, you may want to consider selling some puts as an alternative, simply buying the stock. So we'll cover both strategies, but the focus today will be on covered calls. But know that you can use our platform and what we're teaching you today for both strategies. So what I'm going to cover here today, number one, is what is a covered call, why you should use a covered call for your portfolio. More importantly, how can you generate consistent income in your portfolio using this strategy? And lastly, what I do is I want to spend about 15-20 minutes using the actual OptionsPlay tool to show you guys how to take what we're teaching you today and apply to your portfolios immediately. So that's really the most important piece. Is I want you guys to be able to leave this webinar feeling confident that not only did you learn something, but you also have the tools to implement what you've learned immediately in your portfolios. That's the most important piece here, and that's what I really hope to be able to leave you guys with at the end of the hour here. Like Scott said, this webinar is recorded. So if you feel that we're going a little too fast, or if you're brand new to options trading, make sure that you view the recording. Make sure you understand the concepts and go through the recording and watch kind of how we're walking you through using our platform, so that when you're actually utilizing OptionsPlay to help you find your next covered call or short put to sell, you're using it properly. Okay, so this is one of many webinars that we're going to be running. I think this is the third one in the series that we've done so far. We'll be back in another 2 weeks to do another webinar. But today, let's focus ourselves on how to generate consistent income in your portfolios for the stocks that you own in your account, or for the stocks that you want to own in your account. So number one is just very quick, what is a covered call? Now, before I get into this, if you've traded options before, if you've traded covered calls before, type yes into the chat window. And if you're brand new to options or still learning how to trade options, type no. Just so I just want to get an idea as far as, how many of you are newer to options and how many of you have been trading for a while. So it looks like it's a fairly, I would say, even split here of yeses and nos. So seems like many of you have traded options, but it seems like plenty of you have also are new to covered calls or new to options as a whole. Okay, so let's just cover real quick, what is a covered call? It's a really simple strategy. It simply requires that you currently have a stock position. So any stock position you have that has 100 shares that you have of is a position that's eligible to sell covered calls. And once you have your stock position, all you have to do is sell a call option for income against the stock that you've owned, and that is what we call a covered call. So it's very simple. You take the stock that you currently own, you sell a call against that stock that you own, and that generates income, and that's what we call a covered call. Okay, so let's walk you through why you should consider selling a covered call. So the strategy itself generates consistent income in your portfolio. That's the number one reason why you want to sell covered calls, right? Because options expire, you get to do this month after month, and you can generate an income stream for the different stocks that you have in your account. You can lower the volatility and the net cost basis of the stocks that you own or your overall portfolio by selling covered calls, because the income that's generated offsets the cost basis as well as lowers the volatility of the overall portfolio. And the best thing of all is the fact that you use it on existing stocks in your portfolio. So that means that you don't have to go out and buy some new stocks. You don't have to add additional risk. You don't need any new capital in your account in order to generate income. You can use the existing stocks with the existing amount of capital that you have in your account in order to generate some income. Now, there are some limitations to this strategy, so it does limit the upside return of your stock that you own. So it's really important that we understand how we pick our strike prices when we sell our covered calls, and I'll get to that in a little bit, how the different strike prices affect this type of strategy. It does require at least 100 shares of the stock minimum in order to do this. So if you have some stocks that you only have 20, 30, or 50 shares of, you cannot do the strategy. You need at least 100 shares. And I will touch up on at the very end what to do if, let's say, you don't have enough money to buy 100 stocks, how you can still take advantage of this strategy. We'll talk about that at the end, so make sure you stay to the end. I'll talk about what we call a poor man's covered call. And lastly, when you're trading this type of strategy, you do risk losing this stock. So if you own some stock, you must, when you're selling a cover call, you must be okay potentially with losing the stock. We will talk about how to minimize that risk, but there's always the risk of you losing that stock and selling that stock, which may generate a tax bill depending on what type of account you have. So make sure you understand that before you place this type of trade. So how do you generate consistent income using this strategy? Now, before we can get into how to generate consistent income, it's really important to understand that this is not a one-size-fits-all strategy. So each one of us is different. We have different, how actively we trade. We have different risk tolerances. It's important to understand that you want to know what these differences are before you start selling covered calls, because you need them in order to help you find a suitable expiration date and strike price for the covered call that you're selling. So how do we determine that? We'll talk a little bit about how frequently you trade will help you determine your expiration date, and what your risk tolerances will help you select your strike price. So the key to generating consistent income in your portfolio is simply, it's very easy. It's just to use the same methodical approach every single cycle. So we're going to teach you today how to pick a correct expiration date based on how frequently you trade. Then we'll teach you how to pick a strike price based on your risk tolerance. And all you have to do is stick to that month after month, quarter after quarter to generate consistent income in your portfolio. And what I'm really going to do is spend the time showing you guys how you can do that on OptionsPlay, because we automate a lot of this work for you. That's how you're going to be able to gain consistency, is through automation. That's what we're going to teach you here today. So let's talk about expiration dates, because when we're selling covered calls, there's two things we need to look at: picking an expiration date and picking a strike price. So let's take a look at picking an expiration date. What are the different choices and how do they affect the amount of income you receive? So up here, I have three different categories. I have active traders, I have casual investors, and buy and hold investors. Active traders are really someone like myself. I have time to look at my portfolio every single day. I tend to make trades very frequently, so I would typically want to choose short-term options, so anywhere from 21 to 49 days out, so anywhere from 3 to 7 weeks out. So this is really in the weekly option range, because weekly options are listed anywhere from 1 week to 7 weeks out. You know, as an active trader, I primarily trade only weekly options. On the other end of the spectrum, this is your buy and hold investors. So for those of you that simply buy a stock and hang on to it for months or quarters without, maybe looking at your account once a month or once a quarter, you would fall under the buy and hold category. You would typically want to trade long-term options, so anywhere from 3 to 6 months out, because you're not trading very frequently. And then many of you may fall somewhere in between, or what I call casual investors. This is for those of you that might look at your account once a week, once every 2 weeks. You want to choose typically medium-term options, so anywhere from 1.5 months to 3 months out. Okay, so like I said, depending on how frequently you trade, you should make a mental note to yourself, which one do you fall under. That's going to help you determine which expiration dates you should typically pick when you're selling cover calls, because that's what you want to stick to every single month or every single quarter. So let's take a look at how do the different expiration dates affect the amount of income you receive. Now, depending on how far out you go with your options, that's going to help you determine whether you have more certainty between what's going to happen between now and expiration, or less certainty. So what do I mean by that? If I'm trading a 1 month option, I have a fair amount of certainty as to what's going to happen between now and expiration, because things like earnings dates, dividends, maybe even product launches or things or anticipations in terms of news, these types of things, you have a fair amount of visibility if you're only looking 1 month out. Versus if you're looking 3 to 6 months out, you may not know when that next dividend is. You might not know when the next earnings date is. There's maybe product launches that you're unaware of. There's a lot of uncertainty built into it when you're looking 3 to 6 months out. So the question is, what's the difference, right? So the answer is, the more certainty you have, the less income you're going to receive, okay? The less certainty you have, the more income you're going to receive. So the further time and out that you're going to go, the more income you're going to receive. The less time you go out, the less income you're going to receive. So the question is, why shouldn't I just always trade long-term options if I'm going to get more income? And that's what we wanted to evaluate. We wanted to look at selling 1 month calls versus 3 month calls versus 6 month calls on the S&P 500 stocks for the last 10 years. And we wanted to see what was the actual performance of these strategies. And the answer is, it's better off to stick to the shorter end of the spectrum, meaning the shorter term, the weekly options, the 3 to 7 week options gave us the highest returns over the long run. And this was primarily due to 2 things. Number one, we found that you generally want to avoid selling calls during the earnings announcements. So if you're doing short-term calls like 1 month calls, you can sell 12 times a year. So, and we know that there's 4 earnings cycles every single year. So roughly a quarter or 25% of the calls that you sell have this large uncertainty factor built into it. So only a quarter of them have this large uncertainty factor if you're doing shorter data calls. But if you're doing longer data calls like 3 month calls, number one, you could only sell those 4 times a year because you're going 3 months out. So that means 100% of the calls that you sell have this large uncertainty factor of earnings built into it. So you really can't avoid selling during earning seasons when you're doing 3 month calls. So you just have to simply accept that large uncertainty factor. And that's really where we see the largest underperformance of the strategy is during earnings. So our suggestion to you is sell shorter dated options. Even avoiding the times when there's earnings will still yield you better results in the long run. So even if you only do 8 out of the 12 months of cover calls and the 4 months that there's cover calls, you skip those 4 months, you're still going to get a higher return than doing 3 month calls because of the fact that you have that large uncertainty factor built into it. The second reason is because premium is not linear to time. What do I mean by that? So if you sell a 1 month option for X amount of premium, so let's say you sell a 1 month option for $1, theoretically, you would expect that you would get $3 for going 3 months out, but we're not seeing that. In reality, when you're going 3 times the amount of time going out, you're roughly only going to get 2 times the amount of premium. If you go 6 times the amount of time out, sometimes you're only going to get 3 times the premium. So the further you go out, you're not necessarily getting paid for that amount of time. So you can actually sell a 1 month call 2 months in a row and still receive the same income as someone who's selling a 3 month call, and they have that large uncertainty factor built into it. So that's really why, because of these 2 reasons, that you generally want to sell shorter dated options if you have the ability to, based on historical performance. That's going to give you the highest return in the long run. Next, let's take a look at strike prices. So it's really important to understand how to select your strike prices. And the best way to understand which category you fall under is to think about your risk tolerance. So I have 3 buckets up here: conservative, optimal, and aggressive. So conservative really is for those of you that are maybe you've owned your stock for a long time and you don't want to lose your stock. Maybe it will generate a huge tax bill for you, or maybe you own some dividend paying stocks that you rely on the dividend for, and you want to make sure you keep that dividend. You would fall under the conservative end of the spectrum in terms of risk tolerance. You don't want to lose your stock. On the other end of the spectrum, we have what's called aggressive. This is for those of you that are looking to chase yield. You don't mind if you lose your stock. That's not a concern of yours. You just want to make sure you maximize your income. You would fall under the aggressive end of the spectrum. And then most of you, like myself, would fall under the optimal end of the spectrum. So this is for those of you that are not not too conservative, meaning you don't have a lot of stock that you have low cost basis on, and you're not really trying to chase as much yield as possible and lose all your stocks. You're trying to find a nice balance between risk and reward. That's where you would fall into the optimal. So I fall into the optimal myself. So before we move on, make a mental note to yourself. Which one of the three categories do you fall under when it comes to risk tolerance? So if you're a conservative, you generally want to choose your strike prices using a delta. And the reason for this is because delta is pegged to probability. So when we talk about consistency of the strategy, what I really mean by that is having the same probability of the stock being called away when you're selling cover calls. So on a conservative basis, you want to choose something with a 10 delta, roughly a 10 delta, or a 90% probability that the stock will get, 90% probability that the call will expire worthless. So only a 10% chance that your stock will get called away. An optimal would be a 20 delta call or an 80% chance that the call will expire worthless. And aggressive is roughly a 30 delta call or about a 70% chance that the call is going to expire worthless. So when you're selling an optimal call that has an 80% chance of that call expiring worthless, that means 4 out of the 5 trades that you make, or 4 out of the 5 cover calls that you sell, you should expect to keep that income, and 1 out of those 5 trades that you make, you end up potentially losing your stock. For the conservative one, 9 out of 10 trades that you sell should expire worthless or allow you to collect the income, and 1 out of those 10 where your stock might get called away. So it's really important to use delta to help you determine which strikes to select, because delta accounts for different changes in volatility. It accounts for the fact that there's earnings coming up or dividend coming or any large uncertainty factor coming up, and it will adjust the strike prices in terms of the distance away from the current strike price. And delta is the only way that allows you to dynamically change the distance from the current strike price based on volatility. You can't do that if you're using 5% out of the money or 10% out of the money. That's a very common way to select cover call strikes. However, if you select 5% out of the money every single time, you're going to get different inconsistent results, because 5% when there's earnings is different than 5% when there isn't earnings. So that's why we use delta. So make sure you understand that. So when we evaluated the different strike prices, we also tested this across the S&P 500 stocks over the last 10 years, and we wanted to see how these strategies performed. So number one, when you're choosing conservative strikes, this means you're choosing a strike price that's relatively high. That means you have more upside for your stock to run before the stock gets called away. And that inherently means less income, because you're choosing a strike price that's very far away. On the other end of the spectrum, if you're choosing aggressive strikes, you're choosing lower strikes, those strikes that are closer to the current price. It gives your stock less upside to move before the stock gets called away, and in turn, you're going to get more income for this. So the question becomes, which one of these 3 strategies based on historical backtests gives you the better return? And the answer to that is, again, more on the conservative end of the spectrum. So we've tested all the 10, 20, 30, 40, 50 delta calls, and we want to see where do we get the best performance. And the answer is towards the conservative end of the spectrum. And the reason for this is because cover calls have a negative risk to reward metric. What that means is that the reward that you receive is limited to the premium. So if you sell a cover call for $1, no matter what the stock does, the most amount of money you can make from that cover call is $1. No matter what, you can't make any more. However, the lost opportunity is unlimited. So if you sell a cover call at 100 and the stock shoots up to 120, you are not going to participate on that appreciation from anything above 100. So if it goes from 100 to 120, even though you've collected $1 on the trade, you've now lost out on $20 of appreciation. It's not a real loss because you haven't lost, you're not taking a real loss, but it is lost opportunity because you've owned the stock because you think it's going to go up in value, but you're not going to be able to participate in that because you've sold the cover call. So because the lost opportunity is unlimited and the reward is limited, that's really why it's best to give your stock upside. Meaning giving your stock upside is more important than trying to collect an extra 50 cents on a cover call, because the stock can shoot up significantly and you're going to lose out on that capital appreciation. And that is really what contributes to underperformance of covered calls in the long run is if you get too aggressive with your calls and you're not letting your stock appreciate in value when they're going higher and you're losing out on that upside. That is when we see significant underperformance of the strategy. So it's really important to prioritize giving your stock upside room versus having big fat premiums. So once we've determined that what is the best expiration date and strike price to choose based on your the frequency you trade and what your risk tolerance is. Once you've selected your expiration date and strike price, how do you know am I getting enough income from the covered call that I'm looking at? And the answer here is to compare your covered call yields to the dividend yield of the stock. The rule of thumb here is make sure you beat the dividend yield with the covered call yield. If you don't know how to calculate covered call yield, that's okay. OptionsPlay actually does that for you, and I'll show you that in 1 second. So you don't have to calculate any of this on your own. So I have 3 examples here. I have the first example here where I have a covered call that's yielding me a 3% yield on a stock that pays a 1% dividend. This is kind of your best case scenario. You've increased your yield from 1% to 4% by adding a covered call to it. These are the types of opportunities that you want to look for when you're selling covered calls that beat the dividend yield. The second example here where you have a 3% covered call on a stock that pays a 3% dividend. This is what I would consider your bare minimum, the threshold that you need to exceed in order for you to be selling a covered call and risking losing that stock and risking losing out on potential upside return of the stock. So you want to make sure you at least beat the dividend. And lastly, here's an example where you have a 1% yield on a stock that pays a 3% dividend. This is the type of opportunities that you want to avoid because you're just simply not getting enough yield for the risk of potentially losing the stock and the risk of the stock going above your strike price and you losing out on participating in that. So you want to beat your dividend yield at the very minimum in order to sell covered calls. So just to summarize, based on all the back-tested results that we've looked at using OptionsPlay over the last 10 years, when you're choosing your expiration dates, it's better to prioritize certainty, meaning what's going to happen between now and expiration over premium. Okay, so make sure that certainty is a bigger deciding factor than premium. And when you're selecting your strike prices, giving your stock some upside room to run is more important than collecting an extra 20-30 cents by getting more aggressive with your covered calls, okay, at least in the long run. So based on our back test, when choosing an expiration date, short term, anywhere from 21 to 49 days out is a good time frame to look at, and that's going to yield you the best results. Strike prices roughly around a 15 delta call, so somewhere in between optimal and conservative is where you're going to get the best return profile in the long run. And based on these types of metrics over the last 10 years on the S&P 500 stocks, we're seeing roughly about 3.4% outperformance above the stock performance by selling covered calls in your portfolio. So now that we've gone through all of this, and I know that I've gone through a lot of numbers, I don't expect all of you to memorize this, and you shouldn't memorize it, okay? Because OptionsPlay is here to help you with the process of actually going through what I'm showing you to make it as easy as possible. You don't have to memorize anything that I just showed you. OptionsPlay will actually show you how you can do everything that I just taught you in an automated fashion as easy as possible. So for those of you that are brand new to OptionsPlay, again, you can find us by clicking on the OptionsPlay tab on the upper right-hand corner, or you can simply go to Add Widget and click on OptionsPlay in order to add this tab to your trading platform. This is available for all of you with a live trading account. So if you've never seen OptionsPlay before, I highly recommend you to launch it because it's free of charge with your Regal Securities account. It is a really powerful tool for anyone that's trading options. If you're a beginner, this tool is designed to help you inspire you and help you analyze and explore and learn about options. And for those of you that are currently trading options, this tool is designed to save you a lot of time. So if you're trading options today, you're likely using an option chain. It takes quite a bit of of time to go through every single expiration, every single strike price. Then, sometimes you find a strike price, then you have to figure out how much premium is there, and then you have to calculate those yields. There's a lot of manual and tedious work involved with selecting an expiration date and strike price when you're using the chains. OptionsPlay changes that whole thing for you. So we have trade ideas and watch list here on the left. We have our security analysis panel here in the middle, and we have trading and income here on the right. So trade ideas is fresh ideas for bullish and bearish ideas for you every single day. The watch list provides the ability to create your own watch list and follow the stocks that you want to follow or stocks that you own. I've created a cover call watch list here for today's demonstration purposes. The security analysis panel is designed to help you quickly identify what's currently going on with the stock. So we have a technical score to let you know what the relative strength of a stock is, and the 1 month and 6 month trend indicator to give you an idea as far as if it's trending higher or lower. And these two combined with each other give you a very clear indication as to whether the stock has strong relative strength or weak relative strength. So here AT&T is clearly a weak stock, and the 1 month and 6 month trends are both trending bearish. And you can see that the stock has actually been in this bearish trend since March 20th or March 19th here. So this will actually show you how the stock has performed since the trends have turned bearish. It's really powerful. We're going to do a separate webinar just on these two indicators alone so that you guys can learn how to use OptionsPlay to gain a directional edge. But today we're going to focus more our time on trading and income. So whether you're bullish or bearish on any stock, we always present to you 3 bearish strategies for a bearish stock like AT&T, or you can always click on I'm bullish and be presented with 3 bullish strategies. This is designed so that you don't have to start off using an option chain every time you want to place a trade. So if you're bullish on AT&T, you simply click on I'm bullish. We'll present to you 3 bullish strategies. These are starting points. And then you can say AT&T's at $31.40. I think it's going to go up to $34. How will these strategies perform? So if you bought the stock, you make an 8% return. If you bought the call, you make a 129% return. If you bought the spread, you make a 177% return. So it's a really powerful tool for those of you that are trading options to allow you to quickly find a strategy to look at, analyze, but more importantly, also modify and change those strategies so that you can suit your trading views on the underlying stock. So that's what you do with the trading tab, and we're going to do a separate webinar just on that. But today we're going to focus on income, because today we want to show you how easy it is to use OptionsPlay to find your next cover call idea or short put idea for those of you that are selling puts. So when you click on the income tab, make sure the first thing you do is to click on the income settings button here at the bottom of your page. This allows you to put in short, medium, and long term for your expiration date, and conservative, optimal, or aggressive for your risk tolerance. So again, based on everything that we've discussed here today, I prefer short term because I'm more on the active side of things. I look at my account pretty much on a daily basis. So I would choose shorter dated options. And for risk tolerance, because I'm not too conservative and not too aggressive, I choose optimal for my covered calls. Now, for those of you that sell puts, you can actually set these independently of each other. So when I sell puts, I like to get a little bit more aggressive. So I chose aggressive on my risk tolerance, but I keep the short term. Once you put in these settings, all you have to do is save as default. And now for any stock that you type in or use, and I just created a watch list here, for any stock that you type in, we will go out and find you that short-term optimal call or whatever call that you put your settings into, so that you never have to pull up a chain and scroll through pages and pages of expiration dates and strike prices to find the cover call that meets your criteria. Boeing's trading at 344 right now. As you can see, it immediately tells me that I should take a look at selling the June 1st 362.5 covered calls. So this is essentially going out, finding the short dated expiration dates, finding the strike prices that are closest to that optimal setting, which is an 80% chance of expiring worthless, and bringing it back to me so that I don't have to do any manual searching, okay? And you can type in the number of shares you own. So let's say you own 300 shares of Boeing. And this will describe to you exactly how the strategy breaks down. So especially for all of you that answered no at the beginning of this webinar and said you're brand new to options and you're learning, this tool is designed so that it helps you better understand each one of these strategies. So it tells you that selling one contract or selling the June 1st 362.5 calls will generate $489 in income. This produces a 7.51% annualized return, and there's an 80% chance that this call will expire worthless. So all the metrics that we talked about, 23 days out, meaning short term, 80% chance of expiring worthless, already does all that work for you, and it tells you the annualized return of this call. So this call pays a 7.5% annualized yield on a stock that pays you a 2% dividend. So if you own Boeing today, you're getting paid 2% yield on the dividend. By adding a covered call to it, you're adding an additional 7.5%, which brings your total yield to 9.5%. These are the types of opportunities you want to look out for when you're selling covered calls, because you're adding substantial yield to the stocks that you currently own in your account, and that stocks that you're holding on to because you think they're going to appreciate in value over a period of time. This is a way to take those assets that you have in your stock portfolio and start utilizing those assets and start generating some income using that. So let's just look at a few other examples. I just want to show you how easy it is, right? So I have a list of 22 stocks here on the left, and I want to show you how easy it is for me to go through all 22 and instantly know if there's a cover call opportunity or not. So Microsoft's trading at 96.94. It'll ask me, do I own shares of Microsoft? I type in yes. I can type in the number of shares. So let's say I own 200 shares of Microsoft. It'll tell me to look at selling the June 1st expiration 101 cover calls. So this stock's trading at 96.94, almost 97 bucks, telling me to sell the 101s, which is roughly $4 out of the money. In the next 23 days, this will yield me 6.38% annualized return on a stock that pays a 1.75% dividend, which brings my total yield to 8%. So if you own Microsoft today, you're going from a little under 2% to a little over 8% by selling cover calls. This is why this is an attractive way to potentially use the assets that you currently own and generate some additional yield on those stocks, okay? So, and for those of you that are brand new, if you're starting out and you want to make sure you understand your risk before you pull the trigger, make sure you hit the trade button. We have what's called a strategy checklist here. It checks for a few different things just to make sure you understand your risks. We look at the probability of this call expiring worthless, whether that's good or not. We look at the annualized return. We look at if there's earnings between now and expiration, a very important thing to look at if you're brand new to options. And lastly, we look at spread and liquidity. This is designed so that you can quickly understand whether a cover call that you're selling is liquid or not, so that you have an idea as far as how easy it would be for you to get out if you ever need to. So one of the coolest things about this integration is that when you're looking at a trade on our platform and you want to trade it, you can simply hit on the preview order button. Sorry, I don't know why that happened here. There should be that strike. Let's take a look at this. On Intel, hit the trade button, preview order. Wonder why it's not finding those strike prices. June 1st. Okay, we'll take a look at that. We'll take a look at that in 1 second. But let's take a look at Intel. Intel's trading at 54.34. This is telling you to look at the June 1st 57.5 cover calls. So telling you to sell a call that's roughly $3 out of the money. This yields you a 9.64% return on a stock that pays a 2.2% dividend. So you're increasing your yield from 2.25% to about almost 12% by adding cover calls to your Intel stock. And I can do this very, very quickly on all the stocks in my account and instantly know what my starting point is for selling a cover call on Micron. So it's telling me to look at the June 1st 57 cover calls. Very, very quickly, within a few seconds, I know exactly which cover calls to look at and what the yield is, so I can decide, am I getting enough return on this cover call, especially on the stocks that you're currently getting no yield on, like Micron. This is a stock that many of you have in your portfolios. You're getting zero yield on this, but you can add an additional 18% by selling cover calls. Very attractive. And you're selling a call that's $6 out of the money in the next 23 days. So roughly more than 10% out of the money, 15% out of the money in the next 23 days. That's going to yield you 18% annualized return on this call. Extremely attractive trade to look at. American Express. trading at $100.50. This is telling me to look at selling the June 1st 104 cover calls. So again, 6.79% return on a stock that pays a 1.4% dividend. This is all designed so that you can go through a list of stocks within a few seconds and know exactly which stocks have a cover call opportunities and which ones don't. So all the ones that you get this green check mark on, that's telling you that we were able to find you both an expiration date and strike price based on what you've inputted. And for those of you that like to sell puts, you can always click on the no button and be presented with an ideas for shorting puts. So if you don't want to buy Apple at 187.36 where it's at right now, you might want to buy it a little lower, like at 182.5. You might be more comfortable buying at a lower price, and it generates some additional yield. You get a 16% yield by selling this put, which allows you to buy the stock at 182.5. So think about putting in a limit order at 182.5 and getting paid $195 to do it, which is roughly 1% of the price that it would take to buy 100 shares of that stock. So you're going to decrease your cost of acquiring these shares by 1% by selling puts. Also a very attractive way for people who want to buy stock but don't want to buy it at the current price to consider looking at selling puts. And you can go through a list of stocks within a few seconds and know exactly which ones have covered call opportunities. So Lockheed Martin, 135, trading at 326, sorry. This is telling you to look at the June 1st 340 covered calls. So this is telling you to look at, this has an 8.5% yield on a stock that pays a 2.5% dividend yield today. So quadrupling your dividend yield. Tripling your dividend yield by adding a covered call. Extremely attractive type of trade to look at. And the way that I've created this is I've created a watch list with all the stocks that I own, and these are just sample stocks that you very well might own in your portfolio. I highly recommend you to set up your watch list with the stocks that you own so that you can simply click on a trade and within 2 seconds know exactly what your starting point is for selling covered calls. So for Verizon, it's trading at 46.38. This is telling you to sell the June 1st 48 cover call, so about $1.40, $1.60 out of the money, yields you an 8.5% return on a stock that pays a very hefty 5% dividend. So especially for those of you that are owning like Verizon or AT&T that have suffered some losses over the last few months, selling a cover call is an interesting way to help recuperate some of those losses. AT&T pays a 6.3% dividend yield, so a very nice dividend yield, but you can still potentially double your yield by adding cover calls, which gives you an additional 7% yield, bringing your total yield to 13%. These are the types of trades that you generally want to look for, and the best thing of all is you can use the existing stocks in your portfolio to do this with. And I'll just leave you with one last thing. So for those of you, I get a lot of questions. I don't have enough money to buy 100 shares. Can I still trade this strategy? The answer is yes. What you have to do is you can simply replace buying 100 shares of the stock with buying a deep in the money put, deep in the money call. So you could buy, let's say, a January 2019, let's say you buy 25 call. As you can see, buying the stock and buying the call are very similar, but instead of paying $3,145 for 100 shares, it only costs you $875 for the long call. And you can sell cover calls against a long call as well. So if you don't have if you don't have the money to buy 100 shares, you may have the money to buy a deep in the money call option, and you can sell calls against that as well. This is what we tend to call a poor man's cover call. So I just wanted to leave you with that. And just a quick summary, make sure you set up a watch list with the stocks that you own. Make sure you go to the income tab and click on income settings and make sure you select the settings that suits you the best. And all you have to do is click on save as default. And now for any stock that you type in, we will bring you the cover call that makes sense based on your own settings and presents it to you so that you have all the data in order to know exactly which calls to sell, what the yield is, and when you're ready, click on the trade button and see the strategy checklist. I'll have to take a look at why. So here for Tesla, it worked really well. So when you click on the trade button, there's a preview order button. So this is designed so that you don't have to enter the trades manually. It'll simply fill out all the things for you. So quantity, expiration, strike price, call put. You don't have to do any of that. You just simply have to type in the type of order that you'd like. and simply click on verify to have the order sent. So this is designed so that you can instantly trade from OptionsPlay. You don't have to go to your option chains. You don't have to scroll through pages and pages of this to find which strikes to trade. You can do it instantly just by clicking on the options tab, OptionsPlay tab, and clicking on the trade button. So with that, I just want to go back to real quick and discuss the 3 exit scenarios before we open this up for Q&A. So when you sell a cover call, there's 3 things that you might 3 scenarios that you'll come across. 1, the stock shoots higher, the stock goes sideways, and the stock goes lower. And I want to talk about how to handle each one once you're in a cover call. So when you sell a cover call and the stock shoots higher, this is really where we tend to see a lot of people tend to panic and they don't know what to do. And the best thing here to do is simply do not panic. If you sold a cover call and the stock shoots up above the strike price and you still have a few weeks to go or maybe even a few months to go, let it sit there. Let it potentially, number 1, have the opportunity for the stock to come down. You don't want to roll early because that effectively locks in a loss. You never want to lock in a loss. What you want to do is you want to hold on to that position. And if you need to roll a position, meaning buy back the call and sell another one, you want to do that only in the last week or 2 before expiration date. And the rule of thumb here is that if the stock goes above to a 90 delta call, that's when you want to potentially exit the trade. But otherwise, you want to hold on to that cover call that you've sold, hold on to it until the last week before you should roll. Second of all, if the stock goes sideways, this is kind of your best case scenario. You just simply want to hold on to your cover call until expiration, let it expire worthless, come back the following Monday, sell another cover call. Lastly, if the stock drops after you sell a cover call, this is the only scenario where you want to roll your positions early. So buy back the stock, buy back the call that you sold. The rule of thumb here is that if you can buy it back at 20% of the original premium that you sold, that's the threshold where you want to pull that trigger. So if you've sold a cover call for $1, if you can buy it back for 20 cents or less, that is the time to consider taking profits and selling another cover call before expiration. So those are the 3 general scenarios that you'll come across when you're selling a cover call and how to handle each one. So with that, what I'm going to do is I'm going to bring this back to OptionsPlay. I will open this up for Q&A. So for those of you that have any questions, please type them into the chat window. I see there's a few questions already. I'll answer them in the form that it was received, and I will make sure that I answer as many questions as possible here. Okay, so let's see. What does POW stand for? POW stands for probability of a cover call expiring worthless. So it's just, and you can use delta as a way as a proxy for that as well. Jasper is asking, aren't you still holding the stock when it goes ex-dividend, even if the cover calls go in the money? Yes, I'm not sure what the question there is, Jasper. If you can clarify, I'd be happy to answer that question. Laura's asking, why is it required to own the 100 shares? Because each call is worth 100 shares, and in order for it to be covered, you need to own at least 100 shares to cover it. So that's really why you need at least 100 shares. Tony's asking, can I sort my watch list to determine which stocks have a 0% yield? Unfortunately, we don't have a way to filter that, but I'm guessing you probably don't have a lot of stocks in your portfolio, and dividends usually don't change all the time. So it's really not that difficult to figure out which stocks have paid no dividends and which ones do. It's usually the tech stocks, the high flying stocks, those are the ones that tend to not pay any dividends. The blue chip stocks pretty much all pay some kind of a dividend. Laura's asking, what is the significance of the color tabs next to the stock names on the left? I think if you're referring to the colors, so the color refers to the trend indicators that I just showed you here today. I didn't get a chance to cover them entirely today, but we are going to come back and do a separate webinar just on all of these trend indicators. But effectively, the ones that are red, so for example, Amgen, as you can see, it's red with a red arrow. That's telling you the 1 month and 6 month trend is bearish. It's telling you the score is 4. That's telling you the relative strength here is weak. So this is on a score of 1 to 10 versus if you look at Boeing, As you can see, it's all green across the board. That's telling you the 1 month and 6 month trend is bullish, and the technical score is very strong, so relative strength is very strong. This is so that you can see what's currently going on with your watch list without even having to click on it. So I can tell you 3M, Johnson & Johnson, Gilead are all weak stocks in bearish trends, and Amazon, Netflix, Boeing are strong stocks in bullish trends without even having to pull up each individual stock. So that's what those colors mean. Great question. Does the platform show the standard deviation? Absolutely. So if you click on the trading tab, you can click on the fourth dot here on the bottom, and that gives you the 1 standard deviation move. So you can select different expiration dates. So if you want to look at the June 8th, which is a 30-day expiration, it'll tell you what the expected 1 standard deviation is for any expiration date that you choose. But you can sell calls without owning the underlying stock. Why the discussion of having to own 100 shares? So again, you can replace, like I said before, you can replace 100 shares with a long call. So that is the only way that you can do this. You can also sell a naked call, but very few people have the ability to sell naked calls in their accounts. So that's why we really only talk about selling cover calls here. Again, another question here: what if I don't own the stock? Then you need to at least buy an in-the-money call option is another way to do it. But this is a strategy for the stocks that you own in your account. If you don't own the stock and maybe you want to own the stock, you might want to consider selling a put. That's an alternative way to potentially owning the stock. Tony's asking, would you still get dividends as long as you own the stock? Yes. So as long as you own the stock, you're going to receive the dividend. The cover call is just additional yield on top of that. So the dividend yield is not worked into annualized return. The 12-month projected yield has the dividend yield. So as you can see, the annualized return of 9.95 here is only for the cover call. The 11.97 that you see here is that cover call plus the 2.02 that you're getting on the dividend. Great question. Where was the other questions? Let's see. Albert's asking, how do you lose your stock? Well, the stock simply gets called away. It's literally sold in your account by the person who's exercised that call. So you don't actually have any control. If you don't want to lose your stock, make sure you buy back your call before expiration date. Doug's asking, do you have a rule of thumb for implied volatility? That's a great question. During the process of us backtesting the S&P 500 stocks over the last 10 years, we found that whether you're in high volatility environments or low volatility environments had almost no impact on the profitability of cover calls. So you can sell this in all volatility environments is what we have found. Brian's asking, my screen is only showing charts and trade and income fields. How do I adjust my screen to see all 3 fields? If you're referring to this, meaning you're only seeing the trade ideas and the chart, you just simply have to click on the button that says Show Trade Panel to see the Trading and Income tab. Let me know if that's what you meant, Brian. Robert, do you show the delta of the proposed call to sell? So we don't use delta. We use the probability of expiring worthless, which is slightly more accurate than delta. But you can always click on the magnifying button on any trade. And at the bottom, there's a button that says Explain Strategy in Greek. So you can see the delta here. As you can see, it's 78.73 versus the probability of expiring worthless was 77.69. So very, very close to each other. Those two are almost identical. Does it use the last dividend? No, it uses the next dividend. So as you can see here, what are we looking at? Boeing. Boeing pays a dividend tomorrow. So this is telling you the next quarterly dividend is paid on May 10th, and it's $1.71. Pat's asking, can you go over technical score in the center and how we modify it based on personality? You can't modify it because it's our own technical score. It's a relative strength indicator. It tells you how strong a stock is compared to the overall market. 10 are the strongest stocks in the market. 1 are the weakest stocks in the market. It simply tells you a measure of relative strength. Doug saying, I've been buying cover calls for KSS. At one point, I bought 1 call at strike price of 64. The stock reached 65, but my 100 shares were never exercised. Why did that not happen? So just because a call is in the money doesn't necessarily mean someone's going to exercise it. It means that they can exercise it, but they have the option. So whoever bought that call option has the option of exercising it, and they can choose to do so or not do so at expiration. That's completely up to them. So you maybe got lucky. It's really hard to say as to why your call didn't get exercised. Can we get a link to the recording? Absolutely. Once we're done with this, we'll be able to send you the recording for this webinar. And again, this is one of multiple series. I'm coming back in 2 weeks. We're going to do another webinar. We're going to do this every 2 weeks. We're going to talk about different topics, showing you how to utilize OptionsPlay. Today was just the tip of the iceberg, showing you how to utilize OptionsPlay for cover calls and short puts. But I know a lot of you trade things like spreads, buy calls and puts, condors, butterflies. We're going to do all of those topics. We're going to come back. We're going to slowly teach you how to use our platform, and we'll show you how easy it is to use our platform compared to using the option chains. It'll make your life a lot easier for those of you that are currently trading options, and for those of you that are starting out. The visual format is just a little easier to get started and understand versus staring at those option chains sometimes can be a little overwhelming. Let's see. Tom's saying that the OptionsPlay tab is not active in my browser. This started last week, so please call Regal Securities. They'll be able to help you out. How much margin is needed for a poor man's cover call? You don't need any margin because the amount of money you paid for the call is the amount of money you need in order to pay for that call. So if, let's say, you're looking at this stock here, which is Boeing, and you don't have the $34,000 to buy 100 shares, but instead you're going to buy, let's say a January 300 call. As you can see, it costs $58.60. That's all the money you need. You can't trade options on margin. You just need to pay the premium. So instead of paying $34,000, you're paying $5,800, and you can sell cover calls against that call option. What is the max risk on charts? If you're referring to the max risk here, the max risk is assuming that you're buying 100 shares at the current price minus the income that you're receiving by selling the cover calls. That's your max risk, meaning that's what happens if you bought the stock right now, sold the cover call, and the stock goes to zero, you would lose $34,234, which is less than what you would risk if you bought 100 shares and you didn't sell the cover call. Patricia's asking, does OptionsPlay search for stock trends? I'm not sure what you mean by search for stock trends, but we certainly provide the stock trends on your watch list or for our trade ideas. So as you can see on the trade ideas, they're color coded so that you can see what stocks are in what trends without even having to click on it. I have a question here in cover calls. Do you want the stock to go up, down, or stay around the strike price in order to gain more profit? So as long as the stock stays below your strike price, that's when you make the maximum amount of profit. So in theory, you would want it to go up to the strike price and not a penny more because, so for example, if Boeing's trading at $344.50 right now, you're selling the 360 cover calls, and the stock ends up at 360 on expiration date, then you made $15 a share on the Boeing stock, and you've made $216 for the cover call. That's the maximum amount of money you can make by selling a cover call. Is you want it to go up to the strike price, but not a penny above it. That's when you have the most gain on a cover call. Great question. Danny's asking, my question is, if I intend to sell a call or put option before the expiration date, what is the minimum time I need to start that process? When you say sell, do you mean to enter the trade or to exit the trade? If you clarify that, that would be helpful. How often do you get called out before expiration? Almost very, very rarely will you get a call exercised early. The only time that really happens is if you have a dividend coming up and the call's in the money and you only have about a week left to go. That's really the only time that it takes. That's really the only time that will happen. And that's really funny. The next question is, does the analyzer take into account ex-dividend risk? So that's one of the things that's why we have the dividend date here at the bottom, so that you know if there's a dividend coming up between now and expiration, you should always look at that before you place a trade. So that tells me, there's only a dividend getting paid tomorrow. So I'm really not that concerned about a call that expires in 23 days, whether this will get exercised early, because this is really far out of the money right now. So unless the stock goes above 360 tomorrow, and even if it does that, I think the chances of this are very, very low. Brian's asking, I'm not seeing that tab either. Which tab are you referring to? If you could clarify for me, that'd be great. Where do you get the projected dividend from? I'm not sure what you mean by the projected dividend. This is the actual dividend yield. So the 2.02% is your actual dividend yield. The 12-month projected yield, if that's what you're asking down here, is simply the yield of the cover call plus the yield of the dividend. That's your 12-month projected yield. Why is the reward amount in the previous order screen greater than the trade estimate recommendation of the cover call? I'm not sure what you mean. So here it says $216 in premium. Click on the trade button. As you can see, the bid price here is $216. So that's the premium that we receive, and you hit the preview order button. You can also see here on the option chain, it's trading at 216, beat by 225. So it should all match up. Everything should be identical. Robert's saying, remind people the far in the future long call, poor man's, is a depreciating asset. Well, this is really why you want to sell cover calls against it. And this is what I was saying before. You're better off selling short-dated options, because the income you're going to receive on that is going to more than enough offset the depreciation of that long call, that long-dated call that you have. So that's why the poor man's cover call is usually the popular trade, and this is why we always tell you to buy a deep in the money call, because the deep in the money calls have very little theta and very little. It's depreciating by very, very little. Versus when you're selling a short-dated option, it's depreciating much, much faster. So you're going to be able to arbitrage that difference. That's really why we want to sell poor man's cover call using a deep in the money call. Danny's saying exit. So let me just see that question again. If I intend to exit a call or put option before expiration date, what is the minimum time I need to start that process, at least within the day, weekday, hour, etc.? So if you absolutely need, it really depends on how badly you need to get out. If you absolutely need to get out, then I would start that process probably on Wednesday or Thursday. If you're okay with maybe staying in it, then I would usually leave that to about Friday midday, and then really at 2 o'clock, if I'm not getting filled, then that's when I'll start putting in maybe market orders. My orders are not getting filled, but anywhere from Wednesday to Friday, depending on how badly you need to get out. The reward amount is the stock appreciation. I'm not sure which reward number you're referring to right now. So if you can clarify that, that'd be great.
I think we just have time for another question or two, Tony.
Okay.
There's another one out there.
This is review, but what are the two rows below the price movement chart mean? I think you're referring to this green and red stuff. So that's just telling you what the 1 month and 6 month trend is and how that's changed over time. So as you can see, Boeing's been a 1 month and 6 month trend is bullish, but as you can see, it's only been bullish for a couple of days. So it hasn't been in that trend very long. So it just simply tells you how long the stock has been in a bullish trend for, as you can see here on March 13th is really when the trend quality started to deteriorate. The 1 month trend went bearish, the 6 month trend went neutral, and the stock has kind of really traded sideways since then. It started to come back a little bit, but we really haven't seen a real trend start here. So the trend indicator here tells you how long it's been in the trend for. And one last question: is there a spot showing intrinsic value and time value of the option? No, we don't do that. But that's something, if you're really looking for that, that's one of the type of things that the option chain is probably best for. It's really easy to quickly spot kind of what are the differences between intrinsic versus extrinsic value. So I do want to point out there are certain cases where the option chain sometimes is just a little easier, but majority of the time when you're trying to search for a trade, when you're trying to find a starting point for whether you're bullish or bearish or looking for income, OptionsPlay provides you with that starting point in a much easier format and presents it to you in a visual and plain English, as opposed to just a bunch of numbers being thrown at you, and you have to go searching through all those numbers to figure out where you want to start. So that's really why we have built OptionsPlay. So with that, I just want to thank everyone for taking the time out this afternoon. I really hope that you guys have found this tool useful for your trading, especially for those of you that are brand new. This is really designed to help you make that initial process of learning a lot easier. And hopefully this also inspires you to start taking a look at some options trading for your portfolio. So with that, I'll pass this back to Scott. I want to thank everyone for coming this afternoon. Like I said, this webinar is recorded, so if you haven't had a chance to view all of it, make sure you look at the recording. And if this is your first time, make sure you look at that recording again before you place your first trade. And we'll be back in 2 weeks to do another webinar for you guys, and we'll talk a little bit about the trading aspect of things, how you can use our platform for trading. So if you're bullish or bearish on a stock and you want to speculate using spreads, things like that, we'll cover that on our next webinar. So thanks again, and I'll pass this back to Scott right now.
And thank you, Tony. A lot of great information, really showing us some great strategies and tips there. So good stuff as always. And thank you to all those who registered and for all the great questions, a ton of questions. I'm glad we were able to get to most of them. So a lot of thoughtful thoughts and questions coming from the audience. And so just a reminder, that's how you access OptionsPlay, a tab in the top right corner of your trading platform. And just to make an announcement about next webinar in 2 weeks, same day, same time. It's going to be the 23rd of May, 3:15 Central Standard Time. And if you have any questions, please contact your platform, your trading platform support team, and they'll be able to help you address any technical challenges or anything regarding OptionsPlay. Okay, thank you everyone, and have a great rest of the day. Bye-bye.